All right, so good evening, everybody.
Good evening, sir.
Good evening.
Good evening, sir.
Yeah, so we looked at, I think this will be faster. We looked at the asset standards in the last class, or we have been looking at asset standards over the last few classes. So in this class, we just continue on our topic of discussion. So I'll just run through what we'll be working with here. Sorry about how my line is not as good as it should be. So we looked at PPE for IS 16, and then we looked at investment property in IS 40. And we're going to take that knowledge into what we'll be looking at here. So where an asset that was previously held, so what we're going to look at today will be non-current asset held for sale.
Discontinued operation.
And discontinued operations. All right, so the idea is whenever any of these ones, whenever PPE or investment property, of course, we appreciate that both of these type of assets would have been, the whole idea of calling them non-current assets is the fact that we're expecting to use them for over one economic period. We're expecting to use them for a relatively long time, more than one accounting year. So what happens with this is where an organization, for some reason, we can think about things like where an organization is reorganizing, restructuring. So we were maybe in a particular line of business before, and we now decide we want to go into another line of business. What will usually happen in that case? Or really, as we change, for example, we changed our administrative head office to another office, or we decided that we wanted to maybe get new IT equipment. And so the old IT equipment are no longer, will no longer be using them. So we want to dispose them immediately. If in the case of reorganization, and that's one of the major ones, in the case of reorganization, you will see that if an entity is going from industry A to industry B or some kind of subsector of that, then the chances are that there are some assets, non-current assets that they would have had in that organization that would be no longer relevant, would now be seen as dead assets. And because of that, they might want to dispose these assets. There are so many reasons why an entity that had previously had either PPE or investment property will now decide that we want to dispose of it. Now, if an entity has decided, even though just that decision is not enough, but if an entity has decided and meets what we will call the disposal criteria, if it has decided and to sell these non-current assets, however, at the end of the accounting period, so by the year end, the current year end, they have not yet sold that asset, but there is a plan. Of course, one of the main criteria will be that there is a plan that that asset will be sold before the next year end. In that case, that non-current asset will no longer be classified as a non-current asset in, if we remember what our statement of financial position looks like, we have non-current assets, under assets, and then, of course, our current assets. Now, that asset no longer is non-current because we're not expecting to get value from it over more than one economic period. We're expecting to sell it in the next economic period. So that non-current asset will be declassified and now be reflected in current assets. So it will now be under current assets rather than non-current assets. So where we have any, let's assume we had a building, our old head office, and we decide we're no longer going to use that building, we want to sell the building. So if that building has not been sold by the year end, but we're expecting that we will sell that building within the next 12 months, then that building will now be removed from PPE and now be reflected as a non-current asset held for sale. That's the core concept of non-current assets held for sale. Do you get my point?
Yeah.
All right. So yes, there are a number of criteria that would have to be met before an asset is classified as held for sale. So our held for sale criteria now, there are a number of them. So first of all, management must be committed to that sale. So there must be a commitment by management.
Market.
Then another important thing is that the asset must be sellable in its current condition. So I usually say when you see a car, for example, that is parked on the road, you see that car parked and you see where they write for sale on that car. If the tires are flat and the windows are broken and all those kind of things, that car is not sellable in its current condition, and so it will not be, it cannot be classified as a non-current asset held for sale. Do you get the point I'm making? So that will be one of the things. So it must be sellable in its current condition. Then a point to this is that the price that is placed for that non-current asset must be reasonable. The price that is placed should be a reasonable price. Do you get that? So one of the things we'll find out, whenever an asset is classified as non-current, as held for sale, then an impairment test should be carried out on that asset to make sure that it is not being stated above its recoverable amount. If we go back to our understanding of PPE, we would have to reclassify that as, do an impairment test to ensure that the non-current asset is being stated at a reasonable price, at a price that is likely that it will be sold for. So the recoverable amount cannot be higher than the carrying value of that. Sorry, the recoverable amount cannot be lower than the carrying value. So it has to be written down to its recoverable amount in the case where that asset is impaired, because the chances, there's a big likelihood that once an asset is classified as held for sale, then it's likely that there's a potential that maybe it's because of technological factors or some other reason while that asset would have been impaired. So an impairment test should be carried out to ensure that that asset is not stated over its recoverable amount. So that's was a reasonable price.
Okay, sir?
Yes.
Sorry, so that's when they say lower of carrying amount
and the recoverable amount
and fair value for
and the recoverable amount, yeah, and the fair value really, and it would have to be the fair value because it is being sold. So we'll have to carry out. We'll talk about impairment very shortly, or very quickly, and we'll discuss all of this. But an impairment test just would have to be carried out to ensure that that asset is written down, if it is impaired, to at least its recoverable amount, and the recoverable amount really will be what you would sell it for. So that will be essentially the fair value of that non-current asset. And all these things I'm going to discuss in very proper detail. We have not gotten there with the IFRS 15, with the IFRS 13 fair value, and also with impairment that we'll talk about very shortly. Now, of course, it must be probable that that asset will be sold within the next 12 months. It should be probable that the asset should be sold within the next 12 months. That's, of course, a big criteria for recognizing non-current assets as held for sale. And then
also,
the final point is that
unlikely.
It's
unlikely that significant changes will be made
to that. Yeah.
Unlikely, yeah, to change the plan
Yes.
to sell the asset.
Yes.
Is it? Did you mention that?
Yeah, but we'll talk about that more when we discuss that 12-month criteria. So
Okay,
it's a reasonable thing to say that it is unlikely, but management must be committed to the sale, means that it's unlikely that there will be a change in that plan. A commitment will mean that we're in the process, as we have, the commitment will be more than, even though a verbal commitment might be acceptable, but what is required in IFRS 5 is that management commitment must be something that gives them some kind of responsibility for ensuring that that sale is carried out.
Okay.
Right? So it's
So
not
like
something they can easily reverse their decision. Yes, like what?
Like reporting to the media, like
It mustn't be outside.
reporting to the media that
The plan
they
has
are
been,
going to sell.
no, that not necessarily, but at least if you want to sell your car, you will not go and tell the media, but at least there will be some kind of commitment on management's part. There will be some kind of information available that management that we have decided to make this sale. So it will not necessarily be giving information to external parties before we agree that that is that asset is held for sale.
I think a resolution at the board of management meeting,
Yeah,
or
and that
board
kind
of
of thing,
directors
that kind
meeting
of thing will be that
suffice.
should suffice as
Commitment.
commitment. Yes, some kind of
Okay.
board resolution or some kind of internal memo served to the staff of the organization will show some level of commitment. Yeah, and then the other point to be made will be that what have we said? Management is committed to the sale. It is sellable in its current condition. There's a reasonable price that has been set. That asset has to be sold. It should be likely that the asset will be sold within a 12-month period. And then finally, there should be an active program to find a willing buyer.
Okay. To locate.
So to locate a willing buyer. So an active program. All right, so that's the 5 criteria for. So the active program will mean that. So that is maybe more related to your point about information being passed across to others. So there must be some kind of program set in place for that asset to be disposed of. It can't just be a passive decision. There must be a program. So if now we're advertising or doing any of those kind of things, that will be an active program to locate a willing buyer. Is that fine?
Yes, sir.
All right. So those are the criteria for held for sale. Now I come to the point that I felt when I heard you earlier, I thought you were making, which is that it is also possible that after 12 months, within the next 1 year, from this year end, as we go from the year end to the next year end, now we've not sold that asset. Now, if the reasons why we've not sold the asset over a 12-month period are because of a temporary delay, then that asset can continue to be carried as held for sale. If it is likely that there has been a temporary delay, but that delay will be overcome very shortly, and then that asset will still be sold, then the asset will still be will continually be carried as held for sale. However, if the reasons that had initially made that asset classified as held for sale have been overtaken by events, and so that asset will no longer is no longer probable to be sold, then that asset will be returned to where it was originally, to its former class, so either as PPE or as investment property.
Okay.
Yeah, and then one other information to make is once an asset is classified as held for sale, depreciation should stop. Because if you think about it, depreciation is the spread, of course. If you come back, and this is why I say if everything ties together in your mind, then you now start seeing the sense in what you're saying. So if we agree that depreciation is the systematic spread of the cost that should reflect economic benefits being generated from that asset, then if we think about it, the primary means of us getting economic benefits from an asset that has been classified as held for sale will be when that asset is sold. So it means that the cost should now be matched with when it is sold. Even if, and I've not said this, I've said this very jumbly, but please remember this, even if that asset is still being used, the depreciation should stop, because the primary benefit that we're going to get from that asset will be when it is sold.
So, because it was already classified
As
as
held for sale.
held for
So
sale.
what we expect to get from it, unlike PPE or investment property, where we'll be getting economic benefits over time in the future, with a non-current asset held for sale, the D-day is going to be the day when we sell it. So at that date, we can now remove it from the books and recognize the incomes that, or whatever the cash flow that has come in.
So, okay. In a situation whereby we cannot sell it,
Yes.
we reverse it, we took it back to PPE.
Yes.
Are we going to charge the depreciation that we're supposed to charge before that we didn't because it was classified as held for sale?
No,
or what?
It will be a change in accounting estimate. So we'll just continue prospectively.
Okay.
Depreciation is by standard a change in accounting estimate.
Okay.
So we'll just continue the depreciation. We'll remeasure it, check how many years are there to its economic useful life, and then depreciate it over that time going forward.
Okay, prospectively.
Yeah, prospectively.
Okay.
Yeah. All right, so that's our non-current asset held for sale. Anything we're forgetting, 12 months, if it's not likely, reverse it back. If it is likely, you still sell it, then you continue carrying it. Stop depreciation. You carry out an impairment test once assets are classified as held for sale, just to make sure that you're not carrying it above its recoverable amount, which is essentially its fair value in this case. That's the basic story. Now we go to the second part of our story, which is discontinued operations.
Sir, please, I want to pray, but you can continue.
All right.
Please. Thank you.
All right. So with discontinued operations, what would refer to discontinued operations technically as a disposal group. And I think that a disposal group is, I like the name disposal group because it helps us get an idea of what we are talking about. It can be simpler in English than a disposal group is a group of assets that are expected to be disposed of in a single transaction rather than as individual assets. Do you get the point I'm making?
No.
Yeah, I heard you. Okay.
No.
So I said a disposal group is a group of assets that are expected to be disposed of as a single transaction rather than as individual assets. So in a disposal group now, what's happening is we're selling, the easiest example for us to be able to understand this is maybe, no, there are a number of examples, but let's think about this now. A company has 4 branches or 4 divisions. Let's use divisions because divisions are semi or at least semi-autonomous. So we have division 1, division 2, Division 3, and Division 4. And let's assume that to make it as broad as possible in our understanding, let's assume that these divisions, Division 1 is makes furniture, Division 2 makes books, Division 3 makes is into farming. I didn't like the fact that. And then Division 4 is, I'm running out of, is a supermarket chain. That's a very significant conglomerate. Now, we can decide that furniture, books, and farming are the activities we want to continue, but we want to dispose of the supermarket chain. In that case, the disposal of the supermarket chain, there will be assets, liabilities. It will have non-current assets, maybe a building, some furniture, plant equipment, all those kind of things. Inventory, all those kind of things will be in that supermarket chain. Now, we want to dispose of it as a single transaction, things that we'll call, we'll look, especially maybe with things like advanced financial management, where we'll be talking about different kinds of business reorganization. This kind of business reorganization where we're disposing a part of a company as maybe a spin-off or a carve-out or something, that will be an example of a disposal group. So we're selling one part of the business. So all the assets and liabilities attributable to this part of the business are being disposed as one single transaction, rather than selling off the inventory in a fire sale, then selling off their generators, selling off their cars and all those things. We're selling all the assets of this division now as one single transaction. Do you get that now?
Yes.
All right. So for a disposal group or for a part of an entity to be classified as a disposal group, the first thing is that it must meet those held for sale criteria. It must meet, the way we've itemized them now, those 5 held for sale criteria, it must meet all of them. That's the first thing. Then the other thing is that once it has met those criteria, then we are going to derecognize all of the assets and liabilities of the disposal group. And we're also going to reflect its activities as a separate transaction. Let me show you what I mean. Now, with the supermarket chain now, in this our hypothetical example, the supermarket chain might have had assets and liabilities. So let's assume the supermarket chain had its own PPE, and let's assume that the total PPE of the company was 500 something, 500 million, for example, right? Without that supermarket chain that had maybe 50 million. That's for PPE. Now it also had, say, intangibles of maybe 10 million for that supermarket chain. The other ones will have their own amount. I'm not interested. It also has maybe inventory of, say, another 20 million. It has cash of, say, another, say, 5 million. Now, what will happen once that disposal group meets the held for sale criteria? Then all of these amounts, so this is 50, 10, 20, that's 80, 85. This whole 85 will be reflected under current assets, because now this disposal group has now become essentially a current asset, because we are going to sell it within the next 12 months. So under current assets now, we're going to have, once you've had your inventory, receivables, cash, under there, you'll have a disposal group or discontinued operations. So you have your discontinued operations as 85. So whether the asset was PPE, intangibles too is non-current, inventory is current, cash is current, all of these things are going to be reflected as one single line item in our financial statement. The same thing will be applicable to the liabilities. Let's assume that there are loan notes attributable to this disposal group. There are also payables that the disposal group, as a result of maybe debt to its suppliers, the disposal group also has overdrafts. Now, all of these are going to also be reflected, removed from their different entries in the statement of financial position and reflected as one single line item under current liabilities. So they will be reflected as a current liability. All of them, even the loan note, even if the loan note were for 20 years and it's essentially completely non-current, all of the total value of the assets of the liabilities, whether current or non-current, will be reflected as a single line item in the statement of financial position under current liabilities. Now, also, whatever that a disposal that a part of an entity is classified as a disposal group would not necessarily, and in most cases, almost certainly in most cases, that part will still continue its operations over the period before the end of the year. So if it were classified, for example, in March and the year end was December, maybe March 31st, it will still trade for 9 months and have financial performance for those 9 months. What will happen is all the income minus all the expenses of that disposal group will get the value. So let's assume income was 10 or 100 and the expenses were, say, 120. So we would have a minus 20 as our loss for the year. Now that loss for the year will be reflected. Now we will not do income and expenses. We will not reflect all of this. All we will have is our loss for the year. That loss for the year will be reflected after the profit after tax. So you have profit after tax, and then you would have loss from discontinued operations. Is that clear?
That's only if it was discontinued before the end.
Yeah, most likely that we don't have to wait till the year end to discontinue it.
But if it was discontinued at the end, then there won't be
exactly at the year end, then it would have been still. We would have looked at the portion of this. Now, please hear that because it's important. We would have looked at the portion of this part of the entity for the whole year, whether it was even discontinued on the last day. We'll remove that its own performance from the performance of other parts of that entity. So really, this March, it will not have started from March. It would have actually started from 1st January if it were classified. If our year end was December 31st, then it will be the whole year that will be removed from the other activities, the other financial performance. It will be separately reflected as profit or loss from discontinued operations, even if we were classified on the last day of the year. Do you get the point I'm making?
Yes. So, sir?
Yes, please.
So what is the difference between doing this, like reflecting it the way you say, and IFRS 8 operating segment?
Yeah,
the disclosure of how do you, like, what's the difference between doing this and actually disclosing it in the financial statement, like the way IFRS 8 says we should?
Okay, the main thing now will be the difference between recognition and disclosure. With this, with a disposal group, we're actually recognizing it in the face of the financial statements. We're actually going to remove a figure. We're going to remove something and adjust something. It's like adjusting and non-adjusting event. If you want to still use those kind of logic, it's still the same. It's essentially the same thing. With a disposal group, if our total PPE was 550 before, and if part to the disposal group was 50, we will remove, we will not write 550 again. We'll actually write 500 for the rest of the PPE, remove whatever it was from all the other assets, and then reflect it as one line item as current asset. Same thing with our liability, under current asset. Exactly. Same thing with the liabilities attributable to that disposal group. Remove all of them from their different places where they would have been before and reflect them as one line item under current liabilities.
Yeah.
Same thing with the income and expenses that were generated. So whether it is revenue or it is other income,
Profit.
cost of sale or it's admin. So all the staff costs, all the distribution costs, all their cost of sales, everything will be checked together. So income minus expense, we get our net figure. Is that net figure that will now be our profit or loss from discontinued operations?
Okay.
Separate thing. So once we've done our revenue, cost of sales, admin, distribution, finance cost, tax, that one would be for the normal. So in this our hypothetical example now, the other three parts of the business would have been the parts of the business that will get all the revenue, cost of sales up to profit after tax. Once we've gotten up to profit after tax, under profit after tax, technically that profit after tax will be referred to as profit from continuing operations or loss from continuing operations. And then under that, we'll now have profit or loss from discontinued operations. That profit or loss from discontinued operations will be the net of the income minus the expense. Every expense, whether it's finance cost or tax or cost of sales, everything will be subtracted from income, whether the income is from ordinary activities or from, I don't want to say extraordinary because we don't use that term, but extraordinary activities, wherever you got the income from. Income minus expense will give you your profit or loss from discontinuing operations as a separate item from the rest of the company's performance. Yes, please go ahead.
Okay. So are you going to treat it separately from continuing operation?
Absolutely.
Like you break down, okay, these are expenses for discontinued operation, this admin, this, like you do it separate from our continued operation.
Absolutely.
And get the result, get the whether it is profit or loss.
Yes.
So you just take the whole bunch of the figure, total figure, to profit after tax. That's below, that's below tax. Profit after tax. You present it there.
Yes.
That's just what you do.
Yes.
Okay. So anything that relates to that belongs to that particular discontinued operation will no longer be involved in continued operation.
Yeah.
Okay.
Absolutely.
Okay. So the difference here is this one is recognition. Don't we do in the face of a financial statement? Whereas that one is disclosure.
What's the name again?
Disclosure.
About operating segment.
Ifrs.
Operating segment. No operating segment will not affect revenue that you had in your revenue will still be there. The only thing is go and break down those operating segments into the different aspects of how you got the revenue, and we'll come to talk about that. I don't want to spend a lot of time because that's part of our in the class. We've not gotten there yet, but with an operating segment, we'll just remove those different. So if they meet those reportable segments, then we'll go and disclose them in one of the notes to the account.
Okay.
It will not affect any value.
We'll report it.
Yes, it will not affect any value in our financial statements.
Okay.
So just for the end of our story, let's assume revenue 500, cost of sales 200, gross profit. No, I don't care about gross profit. That's why I didn't put any other one. So admin 50, distribution 20, finance cost 10, tax 30. Let's assume we had all of this as our performance for the year. And then we had, so let's assume that our discontinued operation now was 100 here. This was 20. This was 10. This was 5. This was, say, 3. And this was 7. Let's assume we had all of that. So what will happen now, how we'll prepare this financial statement is, so that was our total, and we have our discontinued operations separately. Our final preparation of this financial statement, so this was total, right? Everybody with me? So this is the total now. And this was the one for, sorry. This was the one for discontinued operations. Yes.
Oh, okay. Yeah, you just mentioned it. Go ahead.
So this was our total. This was our discontinued operations. So we have what part of the total was for discontinued operation. What will now happen is, in preparing our financial statement, our revenue in our financial statement will be 400. Sorry, this will be 180. So that you now have a gross profit of 220. This will be 40. This will be 15. This will be 7. And this will be 23. So that once we've done all that subtraction, oh, I don't know what happened to my Bible. So once we've done all that subtraction now, we'll now get our profit after tax. So minus, that's 55, 62, 85. So 85 minus 220, 135, I think. Not really interested in accuracy. I hope the finger is not that badly wrong. So 135, for example, hypothetically, and that will be our profit after tax. That's our profit after tax. Then we would have profit from discontinued operations. Our profit from discontinued operations will now be 100 minus 20, 80, 70, 60, 55, right? So we'll have 55 here. You just write the 55 directly, nothing more. That's how it goes.
Okay.
So you're not going to come and show all this 10, 20, 10, 100, 20, 10, 5, 3, 7. You just give us.
So you just show the net.
Yes, you show the net. Then your notes to the account, you can now go and tell us all the story that you want to tell us, as much as your notes will permit you. But all we just want is the profit. And if we were that maybe your cost of sales was 120, and so you had a loss ultimately, then you just put loss from discontinued operations as one line entry. That's the end. The same thing, of course, you will see, if you get this logic down, you will see the same thing. So there will be 3 line items for a discontinued operation. For a non-current asset held for sale, we'll have only 1 line entry. The line entry, of course, for a non-current asset held for sale will be under current assets. That's all. That's the end. For a discontinued operation, because it has assets and potentially related liabilities, then we would have 3 possible things. The current assets, the one in current assets, the one in current liabilities. So all these liabilities, whether current or non-current, 1 line item. And then, of course, the one as profit or loss from discontinued operations in the profit or loss.
Okay. That's for single PPE.
No, where it was a single PPE, then it will only be under current assets.
Oh, okay,
only one non-current asset held for sale. So non-current asset held for sale will be 1. Oh, this is not good. What did I do? So the non-current asset held for sale will just be 1, just one thing, only the one to current assets. But the disposal group will now be the whole. This will essentially be the 3 of them. If it doesn't have any liability, then the liability will be 0. So that likely that it will have both assets, liabilities, and income and expenses. So we'll reflect all the assets, whether current or non-current, under current assets, all the liabilities, whether current or non-current, under current liabilities, and all the income and expense as a net after profit after tax. So after profit after tax, we'll have profit from discontinued operations or loss from discontinued operations pending. So that's that. That's the story. Nothing more. I don't know. Of course, disposal groups, just like for disposal groups, just like for non-current assets held for sale, where it is classified as a disposal group, then an impairment test should be carried out to ensure that that disposal group is not impaired. So in this case,
go on.
In this case, all the assets of that disposal group will be tested. It will not just be when we talk about impairment. Unfortunately, we've not, which is not necessarily a bad thing, but with impairment, we usually carry out impairment on all assets of the same class. We're carrying out that impairment test, but in this case, we will carry out impairment on every single part of that disposal group when we're carrying out an impairment test on that disposal group.
Okay. So, for example, when you are testing it for impairment,
Yeah.
if you realize there's an impairment, when you recognize the amount, will you still will you follow the same procedure for deducting it from goodwill first and then prorate it on the remaining asset of the disposal group? Is that the way you do it?
That's
Or
a great question. That's a great
there's
question.
another?
That's a great question. But we'll now have to start thinking about what's happening now. If that's the only time that that was my previous example. I changed my mind about it because I hadn't talked about IFRS 3 yet. But I know that everybody in this class has heard about business combinations one way or another. So maybe this is a good class where we can discuss that thing, and that's higher level discussion. Even before we've treated it, we've started discussing a lot of things about it. But great. In a case where this is our hypothetical example now, where we're using a division in a company. A division cannot have it's not likely. It will be hard pressed. I can't really even clearly think of a way that a division would have a goodwill associated with it, except you bought that division from somebody else, and that's really a lot of story now. But generally speaking, a division will not necessarily have. It's unlikely that you will see goodwill associated with the division. However, another very good example, and maybe my favorite example of a disposal group, is where you really have a group structure where you have a parent and some subsidiaries, and the parent now decides to dispose of one of its subsidiaries in a single transaction. Yes. In that case, that subsidiary will be also reflected as a disposal group in its financial statement. And in that case, there's a potential that that subsidiary has goodwill associated with it. If that subsidiary, at the point where it is now classified as held for sale, if that disposal group, if that subsidiaries is impaired, then that impairment will be to write off goodwill first, and then of course write down all the non-monetary assets pro rata of their values. Yes. Of their values. Yes, that is what will be done. Okay. And of course, that is the credit leg by writing down the assets. The debit leg, of course, will be recognize it in admin or whatever our impairment charge will generally be in admin. Recognize it in admin, and so if it might lead to a loss at the end of the day. But you remember that we are taking all of them, so you might have to have added the impairment now to admin. So if you are done plus whatever your impairment charge was. So it might have increased. So let's assume, for sake of gist, that this impairment charge was now plus 100 again. Another 100 added to admin. That 100 would have changed this. So this one will now be minus 100. And that means that you will now have a loss. Sorry. So you will now have a loss on disposal. A loss for, what's that again? Profit after tax. Loss from discontinued operations of 45 in that case. You disappeared. Okay, is that clear?
Admin expenses, but
generally impairment is charged to admin.
Okay.
Yeah, but let's assume that we're impairment of inventory, for example. Then it will be sensible to charge that kind of impairment to cost of sales. But generally, an impairment will be charged, especially if it's an impairment reflecting goodwill, that kind of thing. The general impairment, then it will usually be administrative expense.
Okay. Thank you, sir.
If we had lorries, for example, and those lorries were impaired, and we use those lorries for delivery, then maybe distribution cost to be a sensible thing to charge. So there's logic to why you're charging something to something.
Okay.
Most of the time. But generally, or if there's no further information, then impairment is generally checked to admin.
Okay.
I think this is that. That's the story. I don't think we have said, the technical parts I think we've put on the, if there's any other thing we'll see as we go through this. So we'll just do that so that we can move to IFRS next. So IFRS 5, interesting standard, non-current asset held for sale and discontinued operations, held for sale, an asset previously classified. I don't know why this is written like this. What's this? What exactly is it? Oh, why now? An asset previously classified as non-current, i.e. PPE or investment property. Yeah, that's my words exactly. Whose primary economic benefits are expected to be generated from immediate sale rather than continuous use. Continuing. I think that would be a better way to say it rather than continuous. Continuing use or capital appreciation / rental income. All right, so the idea is we'll sell it immediately rather than either continuing use, that's PPE, or capital appreciation / rental income for investment property. IFRS 5 requires that an asset should be recognized as held for sale if it meets the held for sale criteria. So the 5 of them now, okay, there's 6 actually. So let's see what I think it will be something we talked about. So management must be committed to the sale of the asset, yep. And the asset must be sellable. I don't know why they're complaining about what's the spelling of sellable. I think this is not English, sir. I don't know whether sellable is the word. Is this? All right. All right. The asset must be sellable in its current condition. There must be an active program to locate a willing buyer. The price set for the asset must be reasonable. It must be probable that the asset will be sold within the next economic period, i.e., within 12 months from the classification as held for sale. No. Okay, the classification as held for sale is actually at the year end. Do we get that?
Yes.
Because this is really overly complex.
That's from when it was classified as held for sale.
No, that's what I'm saying. When was it classified as held for sale? At the year end. At the year end, that's when it was classified as held for sale. We cannot classify it as held for sale until we're preparing our financial statement. That's when that's one of the things that I'm constantly trying
to
that we're clear about this. If not, it's not practicable. It's not practical again. You start having issues. The time you prepare your financial statement is the time this thing comes for. So it is at the year end that you classify it as held for sale. For the next 12 months from this year end to next year end, not the day you made the decision, the day it met the held for sale criteria. Classified it as held for sale was at the year end. Just so that we're clear about that. And then action required to complete the plan indicates that it is likely that the plan would be withdrawn or changed, would not. Okay, so that was your point. I actually stated this as something separate, which is good. So I think this is just re-emphasizing, but this was the point you made, right? That the action required to complete the plan indicates that it's unlikely that the plan would not be withdrawn or changed significantly. So yeah, so that's absolutely fine. Now, if an asset meets all the above criteria, and now 6, then it can, I think that's, then it can be classified as held for sale and recognized under current assets in the statement of financial position. Please just remember that all of this under was such a tricky thing. You just put it as the last line item for safety in current assets, but you can put it anywhere in current assets. There's no rule against that. All right. So that's that. Like we said, once the asset is classified as held for sale, and so that's what we said we'll be using this class for now. If we're not likely. So it's the next class I would actually really enjoy this. In a period, but it is not sold by the end of the next economic period, then it should be reclassified to its former class if the conditions that warranted its classification as held for sale have changed. However, however is too far. However, if the reason why it has not yet been disposed of are temporary, and it is likely that it will be sold relatively soon, then the entity can continue to carry the asset as held for sale. So we're just re-echoing what we said earlier. Once an asset is classified as held for sale, depreciation on that asset should cease, even if the asset is still in use. So technically, all our story. Upon classification as held for sale, at the end of the reporting period, So upon classification as held for sale, at the end of the reporting period, an impairment test should be carried out on the asset if it has not yet been disposed. If it has not been disposed. Oh, this is now saying too many things now. Upon classification as held for sale, at the end of the reporting period, an impairment test should be carried out on the asset. And if the asset is found to be impaired, it should be written down to its recoverable amount. Technically, if you wanted to be, because what you're going to recover from this asset is the fair value. So we're just using impairment terminology for this, and we'll come to see this clearly as we discuss impairment in the standard after the next one. So disposal group and discontinued operations. For those of us that are skillful in this thing, what was that our stuff again? You see, we're getting pretty good at this stuff. Oh, I don't know what I did earlier. Dimola?
I'm here.
Okay, I said we're getting really good at this stuff. Oh.
I'm here.
Yeah, I said we're getting really good at this stuff. All right,
As
no
we
problem. At our adjustments now, you see, we learn quickly. At this thing that you were teaching us that day now, change case. All right, a disposal group is a group.
It's not me.
It was you now? Okay, was it Brian? I think it was Brian. Okay.
It wasn't me.
Okay. A disposal group. Now we're looking at disposal group or discontinued operations, like we said, interchangeably. A disposal group is a group of assets and possibly associated liabilities, including income and expenses, that are expected to be disposed of. Is that off or off? Is OF or OFF? Immediately in a single transaction. I don't know why this immediately. Are expected to be disposed of in a single transaction. A disposal group is classified as such if it meets the held for sale criteria. An asset of a disposal group both non-current, all the assets, okay, sorry, the assets of a disposal group, both current and non-current, are classified as a single line entry. Are recognized, are reflected as something not classified. Are reflected as a single line entry, and associated liabilities are classified as a single line item under current liabilities. Okay. Liabilities. All right. So that's that. Right? This is fine, Abi. Follows the logic of what we've been saying.
Yes, sir.
All right. So I don't think I don't know. Is there anything we've missed inside our discussion? I think basically everything we said is what we are saying here. Now, any income less expense associated with the disposal group will be classified as profit or loss from discontinued operations. So we can put after the profit for the year. Is that fine? Any question? So how short this thing is when it is not, and how long it is when we're talking about it is amazing. All right, so that's that. I think that it has captured everything that we want to capture. So we go to our next standard. So we go to IFRS, sorry, IAS 38. And with that, we have looked at the main asset standards in the sense of assets, the way we recognize them. IAS 38 is intangibles, right? I remember discussing this fairly recently. I don't know.
Intangible asset, yes, sir.
What's an intangible asset? What's an intangible asset?
Sorry,
Yes, go ahead.
Sorry, like I want to ask a question about the standard we just finished now.
Yes, please go ahead.
There was something that I read. I think there was something I read about pre-tax. They are talking about something pre-tax profit or loss of discontinued operation.
Yeah.
Yeah, like so I want to know, like I want to get what it means, like what they are actually talking about.
Pre-tax profit or loss from discontinued or from continuing operations.
Yeah.
Yeah, I didn't hear you. Is it from
Discontinued operation?
From discontinued operations, the pre-tax profit.
The when they're talking about the from discontinued. Yes. Like what? Yeah, when they are talking about the presentation and disclosure of discontinued operation. Yeah.
Yeah, that's
so. What does that mean? Like, what are they really?
Because the tax implication of a discontinued operation, though it will be reflected separately. Now, the idea is this: that discontinued operations in many cases could give you tax advantage in the sense that if you're making a loss from discontinued operation, that loss might actually be a tax benefit to you. So you will use that loss to reduce the amount of tax you would have normally paid on your other on the profit from other figures. See what I'm saying here? If you had your tax of 30, for example, right? Can you hear me? If you had your tax of 30, for example, and then you had a discontinued operation that had a loss.
Yes, I can hear you.
Yes.
Yeah.
So if you had your tax originally would have been 30, but as a result of the loss of from your discontinued operation, you now have maybe a tax benefit. So your tax is now a negative figure. That will reduce the amount of tax you would have paid originally. What will be required by IFRS will be that you should reflect as a disclosure this tax benefit you've gotten as a result of discontinuing that operation. Do you get the point I'm making?
Okay.
But do you understand what I'm saying? Because this can reduce the amount of tax you will pay.
So as a result of discontinued operation.
Yes. Go ahead.
Because you pay less tax, you pay less tax as a result of some portion that you are selling actually rather than continue using.
That is in the case where you made a loss on that discontinued operation. Yes, I can hear you. Can you hear me?
Okay, it's only when you make a loss.
It's when you make a loss that it will now have given you a tax benefit. Yes.
Hello?
I can hear you.
Okay. I got it now. Yes, I got it. Yeah. Since when you make a loss, you cannot pay tax.
You would actually get a tax benefit. It will actually reduce. That's your loss carried forward now, and all those kind of things. Your loss will give you a reduction in your taxable profit.
Yes.
So that loss now would have potentially reduced the amount of tax you will pay. Then there should be a disclosure, because that is an information that will be useful for decision making.
Okay. So technically, they are just emphasizing on you stating it that this is the benefit we'll get from the loss we make.
Yes.
Okay. Non-monetary asset without physical.
Yeah, I'm listening. You say it's asset that you cannot see.
Unidentifiable non-monetary asset. Okay.
Yes.
You agreed? You say you agree? Demola, is you were waiting for?
Agree with what?
You said yes now.
That's what I said now.
You said it's a spiritual asset.
Assets that you can't see or touch. Yes, I said so.
Asset that you cannot see or touch. That's shocking. So there are three parts of the definition of an intangible asset according to IS 38. The IS 38 intangibles versus the other intangibles, which would distinguish between. So the IS 38 intangibles are, so our definition of that, and please, I know that the chances are that we always remember the last part of the definition, but the other parts too are important. All right. So first of all, an intangible asset, according to IAS 38, will be separately identifiable. It will be an asset that is independent, can exist on its own, separately. How come we didn't talk about this? When are we supposed to talk about this? That's true. Okay, so a separately identifiable means that it can exist on its own, separate from other assets within that entity. Do you get the point I'm making? Can you hear me?
Yes, sir.
All right. So a separately identifiable means that that asset can exist on its own, separate from other assets of that entity. The second one is non-monetary. The idea is that when I ask what non-monetary means, people will say it means that it doesn't have a monetary value. If it doesn't have a monetary value, then it is not an asset now. By asset by definition, one of the criteria for defining an asset is that its cost must be measured reliably. You must have a figure that you can place on the asset. How are you going to write something as intangible and in your statement of financial position and you say IDK as when they put the value? Is that financial reporting not now becoming madness? So you had your PPE, for example, your PPE was 50 point, maybe 50.76 billion. Then you have intangible and you say, I don't know, or something, because you say it's non-monetary means that it doesn't have monetary value. That's not what it means. What it means is that these intangible assets that we're talking about are not cash or cashish. They're not cash. Cash, for example, a share in a publicly traded company is an intangible asset. Do you agree with me?
Yes, sir.
So a share in a company.
We can hear you clearly, sir.
All right. So a share in a public company is a non-monetary asset. If you say I have 5% of a public company, I'm thinking of an example that will not distract us. But a share in a public company, because if I say if you have share and I call a very big company name, and people will start calculating how much would that thing be, and they'll say I claim it, and they would have missed the plot. By the time they finish claiming it, we've already finished explaining. So a share in a public company, that let's say you have 5% of the shares in a company, you can't go and say that that public company has 1,000 cars, and so because you have 5% in that company, you have 50 cars. That's not how it works. It doesn't make any sense. So your 5% share in a public company is not a tangible. You don't have something you can say that you can go to the company, count 2 of their buildings, 3 of their cars, 1 million of their inventory, some staff, and so on and so forth, and say, this is my own 5% of that company. 5% is intangible. It doesn't have any physical form or substance. But a share in a public company is not reflected under IAS 38. That is why this definition is important, because non-monetary means that it is not money. A share in a public company is money, is cash. It's technically something that is very highly tradable. So that will be an intangible asset, but not an intangible asset as defined under IAS 38. So these definitions are important. First of all, separately identifiable. We'll come to separately identifiable. Truth about it is, if we talk about an asset as something that gives as a resource that has the potential to give economic benefits in the future to an entity, then there are some things that we can look at, like for example, the ambience in a particular organization can be such a big asset to that organization. It might make their customers more comfortable coming there. It might make their staff feel more comfortable with working in that environment. However, ambience, you can't remove the ambience of a place from that place and it will be separately identified. It can't stay on its own. So it will not meet the criteria for defining IS 38 intangibles. So separately identifiable means that that asset can exist on its own, irrespective of whether that entity is there or not. If an asset cannot exist on its own, then it is not, and it will not meet the criteria for definition as an IS 38 intangible. Second thing, like I said, non-monetary means that it is not cash or a cash equivalent, like shares in a company, like bonds. If I bought bonds from a company, am I buying the bonds? Yes. I bought the bonds, so I paid for the bonds, yes. So I'm the investor in that company. That buying of bonds, that bond is an intangible asset. It's not, there's no physical form or substance. It is just a document that gives me the right to collect cash in the future from that company. So that is, and that would be an intangible asset by definition. However, according to IS 38, that's not the kind of intangible asset we're talking about. So only the non-monetary ones, the monetary intangible assets like shares or bonds are not classified under IS 38. So shares and bonds are good examples of monetary intangible assets. And those ones are something entirely different. In fact, as we go through, we're going to talk about these monetary intangible assets. And these monetary intangible assets are treated in other standards, IS 32, IFRS 7, and IFRS 9. That's where we treat the monetary intangible assets. So be conscious that if we want to talk about intangibles in a very strict sense, in a very that we understand it completely sense, then we'll look at intangible assets as either monetary intangibles, which are the ones that are cash or cash equivalents, and non-monetary intangibles, the ones that we now look at as IS 38 intangibles. And then, of course, by definition, what an intangible is in English is that it doesn't have a physical form or substance. So it is not, how did you say it again? How did you say it again? It's not physical. What did you say?
Can't feel it. You can't see it.
Yeah, you can't smell it. You can't smell it really. You can't touch it. You can't, I think you can't feel it too. You can't taste it. So your senses,
You can't see it.
you can't see it. You can't touch it. It doesn't have a physical form or substance. So that's our definition. Those are the three important things in defining intangible assets. It must be separately identifiable, meaning it can exist on its own. It must be non-monetary, meaning it is not cash or cashish, a cash like a bond or a share, and it doesn't have a physical form or substance. Now, if we go through, that's our definition. If we want to use, I know that I've done this before. If we want to use that 10 or 9 now, because we won't have complex intangibles. Instead, we'll have maybe research and development, and then we'll drift away from it very quickly. But if we want to use that, our, what's the word again? That our table of contents, if you will, for PPE, then we can do the definition. Then classes of intangibles, rather than classes, we would have stuff like examples. We'll have examples of intangibles. So examples will be things like patents, things like copyrights, brands, where the brand can be sold on its own.
What of goodwill?
We'll come to goodwill. Goodwill is a problem on its own. So at some point, it will just be good for us to asterisk goodwill and talk about goodwill somewhere. Or if you want to drift immediately, no, I'd rather talk about goodwill somewhere else. Also, we can have things like development costs. And development cost is something that will be good. We'll really talk about this one. We must talk about it somewhere else towards the end. And we've talked about patents, copyright, maybe like trading list or customer list. Customer lists too can be a good example of an intangible. And so on and so forth. So all of these, yes?
How about business name?
A
Can
business
it be?
name is not just your name. It will be more under brand now. If the business name can be sold to give you some kind of, but just registering a business name doesn't make anything. If the brand of that business name now is now something that is sellable, then yes, that will be under brand.
For example, let me just give an example of what I'm trying to say. If you are looking at Coca-Cola, Coca-Cola is a brand.
Yes.
And it's also a business name. And 7-Up is also a brand as well as business name. But when you look at First Bank, is First Bank a brand or a business name? It's a business name. And the name has been in existence for a long. And then if First Bank is now looking at, okay, margin also at this point and does not have any assets, the name still stands. Can that be, more, can it be quantified as intangible assets?
That's the brand. That's the brand.
Still a brand.
That's the brand.
Okay.
That's the brand. What I understand, maybe it's my Nigerian thing. What I understand business name is something you went to CAC to register. You don't want to register company, so you register the business name. Unfortunately, that's where my understanding gets up to that business name thing. A brand is something, it might even be your logo or your name, something as in, if I say, if I put Coca-Cola here, it's like how people use Apple, for example. You just put Apple in front of your shop. It will make people take your shop more seriously. It's the brand. It's the brand. It's the name that they know, or a logo or some other symbol that they recognize as that brand. They trust that product. Anything that's coming from here should have good quality because of this name, because of this brand. That's what a brand is. So that can be separately identifiable. You can put it somewhere else. You can give it to another company to use. Licenses too will be another example of the things that we'll call intangible assets because they are separate. You can hold them separately and use them to generate economic wealth in the future. Did that answer your question?
Yeah.
Yeah. So that's what this is. So that's our definition. I think the next thing is initial measurement or initial recognition first. So an intangible asset will be recognized. 3 criteria: that there is probability that there will be future economic benefit as a result of that intangible, that the cost of acquiring that intangible or producing that intangible can be measured reliably. And of course, that's separate identifiability, even though that's part of the definition. So that is a redundant information. So those are our initial recognition criteria, same recognition criteria from the framework: probable future economic benefit and reliable measurement of the costs incurred in bringing that intangible into existence. Now, initial measurement, just like PPE, all intangibles are initially measured at cost. So all the expense incurred on that intangible are the initial measurement of the intangible. What's subsequent recognition? All expenses incurred on intangible are expensed. We're expensing any intangible, any expense incurred on intangible subsequent to initial recognition is expensed. Full stop.
Sorry, sir?
Yes.
Initial measurement, you say it will be measured at
Measured at
cost then.
cost, yes.
Okay.
Yeah. Then subsequent recognition now. So subsequent recognition, any expense incurred on an intangible is expense, full stop. Then subsequent measurement, IFRS, IAS 38 allows for either cost or revaluation model to be used for an intangible. And if that is not written properly here, I will correct it. But IFRS 8 allows for either the cost model or the revaluation model to be used in accordance with IAS 16. So the same way we do it, if we're using cost, then at every given point, the carrying value of an intangible will be the cost less accumulated depreciation and accumulated impairment losses. Is that clear?
Yeah.
Subsequent measurement, cost or evaluation.
Yes, all these are in
Either
the
of the
notes.
two.
And you know we're going to look at the notes, so just pay attention.
Yes.
Don't worry about writing anything. We have
Okay.
everything there. So the revaluation, we can use revaluation model. If we're using revaluation model, then at every year end, then we will compare the recoverable amount, or we'll compare the recoverable amount with the
Carrying.
with the carrying value and see whether the intangible has gone up. Now, so that's that. Just same with IAS. So in accordance with IAS 16, we do the same. So this brings me to the point. I think I said this in passing, and I knew we were going to get to this point. Revaluation reserve, you would see either PPE, it will be as a result of either PPE or as a result of your intangibles. Those are the two things that can make you have a revaluation reserve in your financial statement. Now, so that's our subsequent measurement. Now we go to amortization rather than depreciation. So the difference between any intangible asset, and I'm saying any intangible asset, many things, including the IS 38 intangibles, even when we look at things like leases too, because a lease is a contract. Things like leases, even if it has a physical asset, we'll talk about amortization rather than depreciation of leases, where we have, when we'll talk about the leases, we'll talk about amortization. So amortization is technically actually exactly the same thing as depreciation for an intangible asset. So amortization essentially is the depreciation of an intangible asset. The systematic allocation of the cost of an intangible over its economic useful life. Now, amortization is carried out for all intangibles except intangibles with indefinite useful life. So if we have any intangible that is being carried and has a finite useful life, we would amortize that intangible. The only intangibles that are not amortized, what is the tangible PPE? What's PPE that is not depreciated?
Land.
Land. So similar to land,
And
intangible assets with indefinite useful life. I usually like to distinguish between indefinite and infinite. What's the difference? Indefinite and infinite. What's the difference?
Is there any difference between the two?
Yes, there is
Oh,
a very marked difference. Sorry, in the, I don't know, I was cleaning
We're
this
supposed to
mic.
talk.
If you wanted to, I asked the question. Indefinite means that we don't know when the life will end. So I have, for example, the land might end one day, but it might end in 300 years or in 500 years or something. That's indefinite. Infinite is world without end. It will never end. Uncountable in nursery school is infinite. Indefinite is just so large that we can't count. So if I bring a grain of, I don't know, like something that is plenty, I don't know when it will end. And it doesn't mean that it might end in 5 years. I just don't know when it will end. That's indefinite. So things like, there are some things that you would have, like, for example, a brand. If you're
Bag of
carrying a
rice.
brand, yeah, I didn't hear you. I had bag of rice. What did you say?
Yeah, this thing is lagging so much.
Oh yeah, it is. Don't just try me and say I cannot count bag of rice with all this for where I count everything. All right. So indefinite means no definite life, as in we don't know when the life will end. Infinite means infinite. Please don't write infinite. It would worry somebody that is marking your script. The only thing, infinite are things that are not like love and all those kind of things that are beyond the scope of, that's now spiritual in your words earlier on. So amortization will be carried out for all assets for all intangibles with definite useful life, with a finite useful life. Now, amortization, the formula for amortization, we'll use straight line method for amortization as a standard practice. So for straight line method, we'll do our costs or revised costs if we are using revaluation divided by minus the scrap over the number of years. That will be our, so residual value, if you want to use the technical term we normally use. So cost minus scrap value or residual value divided by number of years is the formula we'll use for amortization. Now, we can look at revaluation for intangible assets when we're carrying out our intangibles if we want to use the revaluation model. And it's a very similar thing. Technically, in accordance with IAS 16, nothing more to say. The revaluation is carried out in accordance with IAS, just using the same principles of IAS 16. So where we have a downward revaluation, so where the carrying value is greater than the revalued amount, then we will write that down. We'll write the intangible down and then charge to profit or loss. Where we revise our revalued amount is higher than the carrying value, then we'll write that intangible up and then recognize that increase in the value of the intangible in our revaluation reserve. So all of this is very similar to IS 16. Now, the final point, we now talk about, and that's the really important one when we're discussing this, when we talk about internally generated intangibles. Internally generated intangibles are intangibles that are created within an organization. Intangibles like ambience, for example, those kind of things that are intangible. We can't touch them, we can't see them, but they are items of value. Now, where you have an internally generated intangible, IAS 38 says that all costs incurred in producing internally generated intangibles should be expensed. All of them should be expensed. The only time we will not expense a cost incurred on an internally generated intangible is where it meets the development criteria. Now, with internally generated intangibles, the most important internally generated intangible that we can think about is what we call goodwill. And what's goodwill? Now, I like to define this thing in a way that it pays to pay attention to what I'm saying so that you can understand. Goodwill is the will that the good heart people have towards you, whether your customers or your staff, something that people will do for you that they will not have done, that they will say because of you. If you go to market and they say because of you, they're trying to rob you. But generally, where someone will do something because of you, not because of the company, I'm doing it because I care about you, that kind of thing. That's goodwill. That someone has a good heart towards you. Now, goodwill essentially is, think about it, goodwill is all the assets, all the resources of value that an entity has that is not, do not meet the definition of assets. I want you to hear me, and I don't want to say something like if I've discovered something, but just hear the point I'm making. Goodwill is all the resources that an entity has that do not meet the recognition criteria of assets. And so, do you understand what I'm saying? For example, the efficiency of staff is an asset. It's an asset to an organization in that sense, as in the colloquial definition of an asset, not technically speaking, now not in IFRS terms, but the ability of staff, the regard that customers have for a company's product is an asset to that company. I don't know whether you get what I'm saying.
Yes, sir.
However, if you think about it, the efficiency of your staff, the ambience in a particular location, or when we see things like, I remember someone was pointing it out to me that GT Bank, they always have very high quality, the way they do their buildings, it's not a mistake. They have very nice designs. I don't know whether they've started changing, but a while ago, I know someone that had very, very strong dealings with them. And I started noticing it, that their buildings were always remarkably designed.
Yeah, it's part of the
It's part of their
strategy.
brand image. It's part of their brand image. You get what I'm saying, Abi? Now, there are also some places, like particularly banks in Nigeria, that will have very strong ambience. When you get into the banking, you're like, wow. Maybe when you've run business at all before and you sit down in a banking hall, you're wondering, my God, these guys have 200 of these branches. Man, do you know the cost of running this thing? It's ridiculous, man. As in, when they collect your next 3 naira that you don't know where it came from and they give you bank charge, you'll just be like, I forgive you guys, Joe. You guys need the money. You need to survive. But the idea is that there are some things in a business or in an organization that are actually value added, that will create value, that will make a customer come back, that will make a staff stay extra and work harder, and so on and so forth. But these things are not, they cannot be measured reliably. The cost incurred on them cannot be measured reliably. And of course, in other cases, there might be no guarantee that as a result of having these things, that there will be economic benefits generated in the future, even though they are valuable to that business. Now, goodwill really is all the valuable things in a company that do not meet the asset criteria, and so they are not recognized. So, if we will, what we'll now do is 2 things. We'll separate goodwill into 2 things. There's a good reason for it, if you follow what I'm saying. Now, goodwill is everything that is valuable that do not meet the asset criteria. And so, goodwill, by definition, goodwill is an internally generated intangible because it's generated internally within the organization. And by that definition, goodwill is not recognized in the face of the financial statements because, for the better part, it cannot be measured reliably. However, if a company is sold, then most of the time, a company that is sold, a company's assets, by net assets, if you will, might have been 40. When the company is sold to another entity for 50. Why? Because the buyer of that entity now says, for all these things that according to IFRS do not meet the definition of an asset, and so you could not capitalize them and recognize them in the face of your financial statement, I'm going to give you an extra 10 as the value of these things. If I started this company from the scratch, I will not be able to get this level of experience of staff. I will not be able to get this level of customer loyalty. All this kind of customer loyalty is goodwill. That's goodwill to you. It's a valuable asset, but can you measure it reliably? You can't measure the cost reliably. You can't measure it. And so it is only when a company is sold and someone pays an extra beyond what the net assets of that company is for that company that we now have what we call purchased goodwill. It is now purchased goodwill that can be recognized in the face of the financial statement, because at that point, someone has given a value for that asset. And so we can now measure the extra paid, if you will. Now, purchase goodwill by definition is the amount of your purchase consideration that exceeds the fair value of the net assets. I don't want us to miss the point in technical definitions. The amount that a purchaser paid over what the asset minus liability, what the net assets, what your value was, what you called your value, what you called your value, what your value was that you can actually recognize in your books. The extra amount I paid over that is purchased goodwill, and that purchased goodwill can now be measured reliably, and so it has a value in the face of the financial statements. Do you get the point I'm making?
Yes, sir.
Demola?
Technically, it's just the amount of
Yes, I get you.
consideration paid over the value of net asset
Yes,
of the company.
yes.
Okay.
But you can see where it stems from. The fact that
Yes.
you could not have, nobody will come and give you 50 for a 40 value. They're not Father Christmas. The reason why they are giving you this is because you're worth more than 40. It's only 40 that meets IFRS definition and accounting definition of assets, because for you to put something in your books, there must be a value. You can't guess. If you start putting values that, I expect that my customers like me, so I'm going to put customer relationship as 100 million. You just go to prison for cooking books. You're lying. However, is there a value to customers liking you and liking your product? Yes. But can you measure it reliably? No. So you can't put it in your books. That is goodwill. So goodwill is valuable, but goodwill is not recognized in the financial statement unless another entity acquires that entity. In the case of acquisition, the extra that customer or that acquirer, the buyer, pays for that company beyond what it called the value of its assets after subtracting liabilities is now purchase goodwill, and that is recognized in the face of the financial statements. Now, there's one final part to our IS 38 discussion, which is the discussion on research and development costs. Research and development costs are also intangible assets. They have no physical form or substance, so they are intangible assets. However, when we're looking at research and development costs, by definition, all research costs must be expensed according to IS 38. Now, research costs, if we think about research is, I don't know where I'm going to yet. I'm looking for something. I'm trying to improve something, but I don't know where I'm going to. By the time we get to development, I now know where I'm going to. Do you get the point I'm making?
Yes, sir.
With research, I'm still looking for. So at that point, if we think about an asset, it must be probable that there will be future economic benefits generated from the use of that asset. At research stage, it's not probable. It is possible or remote in the worst case. But at development, I now know where I'm going to. So it is now probable that there will be future economic benefits generated. At development now, I can now capitalize development costs. But all research costs must be expensed. On the other hand, development costs must be expensed, except all development costs too must be expensed. Let me say that first of all. And there has to be a capital unless. So unless this development cost meets what we call the development criteria. So all development costs too will be expensed unless they meet the development criteria. And our development criteria are pirate, 6 development criteria. So pirate, it must be probable that the cost incurred will generate future economic benefits. That's one. Yeah?
Yeah.
The next one is that
Yes, sir.
there must be an intention to use or sell the asset being generated. Think about research and development. Research and development, we are trying to create something. We're trying to create an asset, something, some kind of software, some kind of drug, some kind of medicine that will give us, so the patent for this medicine or the formula for this medicine will be very economically valuable. We're trying to create a machine when we're doing development and research. Different things. We're trying to create an asset. So understand, we're spending money. Remember when from our first class, our first few classes, when I talked about an asset is something I spent money on that is going to give me benefits in the future. So every time I bring money out, that's why an expense and an asset are the same thing. I spent money on both of them. If I'm going to get value added in the future, then I'll call that an asset. If I've already gotten the value, then I'll call that an expense. So the logic of development cost is I've incurred that development, or I'm incurring that development cost because I'm trying to create an asset. Now, if it is probable that I will get future economic benefits as a result of the cost I'm incurring on development, then that's criteria 1 met, or criterion 1 met. The second one is I must have an intention to either use that asset or sell the asset. If I'm just doing it because I just want to do an experiment, I don't have any intention to use it or sell it, then that's the end. So I must have an intention to use or sell that asset. That's the second one. The third one is that I must be able to measure that the cost I'm incurring on development reliably. So I can't just wake up in the morning and say, how much have I spent? I'm assuming there must be a reliable measurement. Only the ones that I have receipts for, I have some kind of, if you will, verifiability issues with this. I must be able to measure the cost incurred on that development cost reliably. That's the third one. The fourth one is there must be an ability. No?
Sorry, the third one, sir?
Yes. The third one.
For measurement.
Measured reliably. Reliable measurement.
You mean the cost?
The cost of, yes, of that
okay.
asset must be measured reliably.
Okay.
All right. So the first one, remember the second one was I'll have an intention to use or sell the asset, right?
Yes, sir.
The third one is that I have the ability. I have
the third one.
The fourth one. That I have the ability to use or sell the asset. I have the ability to use or sell the asset. Now be careful about this one with the remaining two. I have an ability to use or sell the asset, that the company has the ability to use or sell the asset. Now, the fifth one is that the company has the technical capacity to complete this development process, that the company has the technical ability to complete the whole project, to make that asset become something that it can use or sell.
Technical ability to use or
No, it's not
sell.
technical. The ability to use or sell was number 4. The technical capacity to complete.
Okay, capacity.
Yes. But
Technical capacity.
Well, I can call it technical ability too. It's not, that's semantics now. That's English. That's not important. I can call it technical capacity, technical ability. Just don't mistake this for this. They are two different things. The ability to use or sell it means that I have the ability to use or sell that asset. If I develop a car that can only move in space, then I might have the intention to use it, but I do not have the ability to use it. I cannot go to space as I am right now. I can't. Even
But
if
if
they're
you
going
can,
to give me free, even if they're going to take me there for free, I'm not going. That's what I mean. So I don't have the ability to go. But whether I have the intention now is a different case. Now, if I can, if I have the ability to use or sell it, it's different from the technical ability to complete the project. I'm developing. I've not made the software yet. I'm at this point, but I can see the software I want to make. Do I have the technical know-how to get to the point where the software is now a software? I am at this point now, I'm producing a medicine. I want a medicine to cure COVID. I'm at this point now, I'm seeing the medicine there. Do I have the remaining technical expertise to get to the end? That's what the technical ability is. Technical ability or technical capacity for completion of this whole process that I am working on. And then the final one is that I have the economic ability, that I have the finances actually to complete the project. Unless development costs meet all these criteria, they will be expense. On the other hand, if a development cost meets all these criteria, then we'll capitalize it. We'll recognize that development cost as an asset in our financial statement.
Hello, sir.
Yes, I can hear you.
The last one for E.
Economic capacity, economic ability, economic capability.
Okay.
The finance, we have the money to get to the end, to make this software, to make the medicine, to make the machine. We have the economic, we have the money to complete it. We have the technical ability, so we have the science, we have the technology to complete it, will be the T. We have an ability to use or sell that asset, will be the A, which is different. Please remember the A, the T, and the E might sound like similar to each other, especially the T and the A. But the ability to use or sell is different from the technical ability to complete that development. If you think about what we're doing, then it will be clearer to you.
Okay.
And then, of course, reliable measurement, intention to use or sell, and then probable future economic benefits being generated. Now, once it has met all these criteria, then an intangible, the costs incurred in development can be capitalized.
Okay. So for T, is technical know-how, like when you have the expertise.
Yes, to complete it.
To complete
that project, yes.
The ability is whether you can finish it and sell it.
That's A. Is that the A or the?
That's it. Okay, A is the ability to use it or sell it.
Yes, we are either going to use it or sell it.
Yeah. But T is technical know-how.
To complete it, to complete the project. So we are saying when we've completed it now, the A is when we've completed it, we know we have something that we are going to use it for. Because really an asset, for you to capitalize it as an asset is something that I'm either going to use or sell. By definition, that's what an asset is. Something I've spent money on that I'm either going to use or sell. I'm either going to sell inventory or sell my stock or sell it, or I'm going to use it. I'm going to use it as PPE. I'm going to use it as investment property to make money. But that's what an asset is. The idea is matching I want to match income with the expenses. If I'm incurring expenses and there's no income that will be matched with it, then I should expense it now. I'm not going to get anything from it. That's the whole concept underpinning all these things we are talking about.
Okay.
So if I'm not going to make money from it, there's no need. I'll just expense it.
Okay.
All right, so that's that.
Okay.
So we're on IS 38. I think this will be a lot shorter than what we've discussed here. I don't think everything is here. I don't think everything is here. Okay, so we'll just skim through this very quickly. IFRS, oh, sorry, not IFRS 5 now. Well, we are IS 38. Not going to be, there'll be, I think, a number of things that are not in this one. I can't remember what we called it. So, identify by definition now. I don't think we'll have. What's this thing? So definition. Intangible assets are separately identifiable non-monetary assets without physical form or substance. The objective of IS 38 is to account for intangible assets that are not covered by other standards. And the idea was that whole, like monetary ones, it would have been great to talk about this thing. Now, an intangible asset covered under IS 38 is said to be separately identifiable, meaning that the asset must, I'll say, be able to exist on its own, independent of other assets of that reporting entity. Then non-monetary. I wish there was a way I could space this thing so that it would be more sensible. Let's not write this thing. Separately identifiable. Okay, so let me take that. But the spacing is ridiculous. Okay, I think I can do that. Non-monetary. By definition, we've already done what non-monetary is. So non-monetary means that the intangible asset is not cash or a cash equivalent, e.g. receivables, shares, or bonds in publicly traded companies. Which are cash equivalents. And then monetary assets are covered under standards such as financial instrument standards. Examples of, so we'll go to our examples now, of intangible assets include patents, copyrights, trademarks, customer lists, marketing rights, all those kind of things. Now, initial recognition, IFRS IS 38 requires that the reporting entity recognizes intangible assets if it's probable that there will be future economic benefits generated from the use or sale of the intangible assets by the entity. And two, the costs of that intangible asset can be measured reliably. So we can go down to our initial measurement. All intangible assets should be initially measured at cost. Okay, so I was very straightforward with this. I don't know why this thing underlines like this. After initial recognition, all costs incurred on intangible assets should be expended. Oh God. It should be expensed. Yeah. IS 38 allows for measurement of intangibles after recognition using either the cost model or the revaluation model. What did we jump here now? Initial recognition, initial measurement, measurement subsequent to initial recognition. Okay, so the cost model. Okay, so the value of an intangible asset at any point is equal to the cost less accumulated depreciation and impairment losses. Amortization and impairment losses for a period are charged to profit or loss. Why are you telling us that? Amortization and impairment. Okay, so revaluation model, under this, the intangible assets are carried at their revalued amount based on the face value less any subsequent amortization and impairment losses. Only if fair value can be determined by reference to an active market. Yeah. Did you get that?
No, sir.
This last part says that if we're using revaluation model, then the only time we can revalue our intangible assets is only if the fair value can be determined with reference to an active market. So only where there is an active market for that intangible asset. Things like, there are few things like patents that would have in active market. If your intangible doesn't have an active market, then you cannot use revaluation model.
Okay.
I will talk about active market. Active market is that there's a place where we can buy it and sell it. So there's a fair value to that asset. That's simple. That's like if I wanted an active market for second-hand cars, I'll go to Beggar in Lagos or somewhere. There's places where they sell cars. That's an active market. That's like how an active market, they wake up in the morning, they go to the market. Stocks and bonds traded on stock exchange, those are active markets. So it is noteworthy that an active market does not usually exist for intangible assets. That's why you will see that most intangible assets, in most cases, 90-something% of the cases, you will see that we use the cost model for intangible assets because there are very few intangible assets that have an active market.
Sir, active market is it level 2? Is it level? It's level 2.
Level one. Level one.
Okay, it's level 1.
Yeah.
Where there's
depends. Identical, yeah. But and then of course there can be active market for level 2, where it is active for similar but not identical products.
Similar.
Okay. Yeah. Okay. All right. So under revaluation model, revaluation gains are recognized in revaluation reserves / other comprehensive income. We said they are the same thing now. Revaluation reserve. But I won't do it if they leave me. So let me just. It makes the note better. So we'll just make the sacrifice. All right. While revaluation losses are recognized in profit or loss in the period in which they incur, yeah, we don't have too many. So we can just put. Let me just put it here. So let me just put it at the beginning here, based on IAS 16 criteria, so that it helps us to know that we're doing the same thing. I'm looking for the way that I can do this properly and it will work. All right, so I think I've solved that problem. So we just put the based on, or maybe it would have been better there, so it's fine. All right, so amortization is systematic allocation of the cost of an intangible asset over its economic useful life. Under the cost model, the amortization charge for a period equals cost minus residual value over a number of years. Just like land is not depreciated under IAS 16, intangible assets with indefinite useful life are not amortized, but should be periodically tested periodically, that's at every year end for impairment.
Okay.
So internally generated / internal self-constructed assets. So IGIs that we talked about, I don't know if we've missed anything. I don't think so though. Self-constructed assets. IS 38 requires that all costs incurred on internally generated intangibles should be expensed except where they meet both recognition criteria. And that's very, very rare. Most of the internally generated intangibles will be expensed. But if they meet so they must be measured reliably and it must be probable that there are future economic benefits generated. In that case, then we can now recognize them. Now, goodwill, holistically, goodwill can be classified into internally generated goodwill and purchased goodwill. So all our gist is what we normally see at the end. Is there anything we've missed from our discussion?
Well,
The way the discussion is so long and the rate is so short is surprising me sometimes. All right, internally generated goodwill. Some resources controlled by an entity will potentially lead to inflow of future economic benefit. However, these resources might not be separately identifiable or might be impossible to measure reliably, or it might be impossible to measure them reliably. Okay. As a result, these resources do not meet the recognition criteria for assets, and so internally generated goodwill, which represents all of these kind of resources, is never recognized in the face of the financial statement. I've said some things very intelligently before. Purchase goodwill is the excess of purchase consideration over the fair value of net assets.
So, sir?
Yes.
So, internally generated goodwill that
Yes.
you just finished now.
Yes.
Like, there's no way you can
Ever
actually
capitalize
recognize it.
Yeah.
You cannot capitalize it
Yes, because it
because
can't be
it is
measured
internally
reliably.
generated.
Because it is
Okay.
because it can never measure it reliably. Anything that will give us benefits, staff enthusiasm, customer
Loyalty and all that.
those kind
Yes.
of things, they can't measure them reliably. So there's
You
no way
can't.
you can
You
capitalize
can't.
it.
So only when you are selling it, that's when you will be able to recognize the
That's our purchase goodwill level now.
purchase. Okay.
Yeah,
Okay.
so we came to that now. So we said purchase goodwill, this is the excess of purchase consideration over the fair value of the net assets of an entity being acquired. Since the consideration is paid by an independent party, the excess meets the measured reliably criterion. So the excess that they are paying meets the measured reliably criterion, and so purchase goodwill is capitalized as a non-current asset in the statement of financial position. Capitalized goodwill is not amortized, but rather tested for impairment at every reporting date, so annually.
Okay.
I can put that.
So because fair value is used.
Yes, please go ahead.
Because fair value is used when I say it is because fair value is used when purchase when the person that's taking over the company is going to take over. So it will be based on fair value, so that's why you will be able to recognize it now as goodwill.
Yes, because someone has paid for it, so it's independent now.
Okay.
There's someone that is paying for it, so because of that independence, then we can capitalize it.
Okay.
It's no longer us, as in you look at yourself in the mirror and say, I am this thing. That's not acceptable. When someone else says it, that's now what gives it more credence, and that's what.
Okay.
I don't like anything that is self-assessment. Self-assessment has a tendency to be very subjective. So we want something that is objective, someone independent made a decision for. That is when it now becomes valuable. All right. So at every reporting date or where there is an indication of impairment, All right, so that's that. Then we go to R&D, our final discussion. So all research costs must be expensed in the period in which they incur, whether product research or market cost or market research. So either product research or market research, all of them should be expensed. Full stop. Now, development costs are expensed in profit or loss, except they meet all of the following criteria. So it's only when development costs meet the criteria that they are capitalized. So the criteria: one, it is probable that there will be future economic benefits generated as a result of the development cost incurred. Two, there is an intention to use or sell the asset being developed. Three, the costs incurred on development can be measured reliably. Four, the reporting entity has the ability to use or sell the assets being developed. Then the T, the entity has the technical capacity to complete the development project. And E, the entity has the economic or the financial ability to complete the development project. Only when all these criteria are met can development costs be capitalized in the face of the statement of financial position.
Okay.
So finally, development costs are capitalized until the asset is ready for its intended use or sale. I kept this till the end. So we continue capitalizing the development costs as we are making that medicine, as we are making that machine, as we are making that software. We continue capitalizing the development costs until the asset is ready for its intended use or sale. So once we have now made the machine and the machine is now ready to be used or sold, then we stop capitalization. They said, and then the final thing, these costs are depreciated over the economic useful life of the asset. So once we have finished the capitalization, then the so the development costs and are depreciated over the economic useful life of the asset. So that's the story for this.
Okay. Oh.
Okay, I think this was fine. I think this is fine. It seems so short compared to what we talked about, but at least we get the summary of our story.
Yes.
All right, so that's that. Any question?